Welcome back. Today we're going to look at monetary policy within an ample reserve framework. In a previous lesson we looked at limited reserves. Today we'll look at ample reserves. And the goal for today is to understand what we mean by ample reserves and see what tools the Federal Reserve has at its disposal to influence economic output in a situation where reserves are ample. Start first though by reminding ourselves the basis of monetary policy. What is monetary policy all about? It's all about interest rates. The Federal Reserve will establish a target rate. It'll establish an interest rate it would like to see in the economy that it believes will create full employment and provide stable prices. This target interest rate will influence the amount of consumption and investment that occurs within the economy. Higher interest rates will lead to less spending. Lower rates will lead to higher spending. This change in consumption and investment spending will cause aggregate demand to shift either right or left, and that change in aggregate demand will lead the overall economy into a level of real output and price level that the Federal Reserve wants to see. So again, monetary policy is all about interest rates. The real issue with limited and ample reserves is how do they get the interest rates they want? In limited reserves, the Federal Reserve changed money supply in order to get the nominal interest rate at a level that they think is optimal. The graph for ample reserves uses a vertical axis of policy rate, and the horizontal is the quantity of reserves. The demand for reserves makes a sort of Z shape. The upper bound is set by the discount rate. That is the interest rate paid by banks that borrow from the Fed. So when banks borrow from the Fed, they either pay the federal funds rate or the discount rate. The discount rate is the highest possible interest rate that banks will have to pay because the discount rate is always set above the federal funds rate. So this serves as a ceiling interest rate for the market. The lower bound for demand for reserves is called the policy rate. This is the interest rate paid to banks for reserves that they leave with the Fed. When banks choose to put money with the Federal Reserve, they receive interest in exchange. The policy rate will serve as a floor for the market because banks will not be able to borrow from other banks at a rate below the policy rate. If Bank 1 lent reserves to another bank, to Bank 2, at an interest rate below the policy rate, then the bank that's borrowing the reserves will just simply put it back at the Fed and earn what they call arbitrage. They'll earn more from putting that borrowed money into the Fed than they're paying to the other bank. They'll earn a profit. So banks are never going to lend to each other at any rate below the policy rate. They'd be happy to lend at rates above, but they won't lend to each other at rates below because of this opportunity for earning profit by borrowing at less than the policy rate and then depositing it at the Fed. Within an ample reserves framework, the supply of reserves are said to be abundant, meaning that a change in supply, either to the right or to the left, has no impact on the interest rate. You can see where the supply is intersecting demand, and if supply shifts to the right, we still stay at the policy rate. If it shifts to the left, at least a little bit, we still have that interest rate set at the policy rate. So the previous tools that we talked about with limited reserves have no impact here. In limited reserves, we were changing the supply of money in order to get a change in the interest rate. But here in ample reserves, a change in the supply has no impact on interest. So what the Federal Reserve uses instead are what are known as administered rates. The Fed sets a goal, a range of interest rates that they would like to see in the market. And they influence that range by changing the policy rate. They will change how much interest they will pay for reserves at the Federal Reserve. The Federal Reserve will still use open market operations. They still work the same way as before with the buying and selling of treasuries. But in this case, it's not to change the interest rate, but to instead maintain ample reserves. So if for some reason the Federal Reserve felt like reserves were not ample enough, they could go into the open market operations and increase the supply of reserves. The decision to buy treasuries will increase the supply of reserves, but it won't have any impact on the interest rate. So the big tools here for the Federal Reserve is the interest on reserve balances, which is the interest rate they pay, that policy rate that we talked about, and the discount rate. So they're going to set that range of interest rates that they want to see. That interest on reserve balances rates sets the federal funds rate, which will be the rate that the Fed pays to banks that keep reserves at the Federal Reserve. The way the Federal Reserve will then operate its monetary policy is by adjusting its administered rates. It can either raise or lower the interest on reserves, and it can raise or lower the discount rate depending on which direction it wants to see consumption and investment move. So let's look at how the Federal Reserve in an ample reserve system would address a recessionary gap. Again, in a recessionary gap, we have output less than long run, which means that the Federal Reserve would like to see aggregate demand shift to the right. In order to get aggregate demand to shift to the right to increase consumption and investment spending, the Federal Reserve will want to lower interest rates. So they can announce a reduction in the policy rate, which will lead to a reduction in the discount rate. And so we see a new demand for reserves created with a lower interest rate. That lower interest rate leads to an increase in consumption and investment spending, causing aggregate demand to shift to the right. If there was an inflationary gap, we'd see the opposite. With an inflationary gap, the Federal Reserve would like to see aggregate demand shrink or shift to the left. The way to do that would be to raise interest rates. So in this situation of an inflationary gap, the Federal Reserve can announce a change to the administered rates. Federal Reserve could announce an increase in the policy rate and an increase in the discount rate. That increase in interest rates makes it more expensive to borrow for both consumers and businesses, which will cause the aggregate demand curve to shift to the left, closing that inflationary gap, causing price level to fall, and bringing the economy back to long-run equilibrium. One last thing that you're going to need to know as you work through the monetary policy and through AP macro, and that has to do with the relationship between interest rates and bond prices, the relationship between interest rates and Treasury security prices. Remember that the Treasury security is a piece of paper. It's a guaranteed payment from the federal government to the holder of that piece of paper. And so that piece of paper can be bought and sold on the market, depending on whether you want to wait for the interest payments over time or if you want cash up front right now. What we see with interest rates and bond prices is a negative relationship. An increase in interest rates will cause bond prices to fall. That is, prices for previously released bonds. And a decrease in interest rate will cause an increase in the price of previously issued bonds. So that a change in interest rate will change our desire for previously issued bonds. And that's what we're talking about with bond prices here. So for example, if the Fed lowers interest rates, it means that the previously issued bonds are paying a higher rate of interest now than the new bonds are. And so investors have a choice. They can either purchase newly issued bonds at that lower interest rate, or they can purchase previously issued bonds at the higher interest rate. Well, the demand for older bonds is going to increase because they are more attractive. They pay a higher rate of interest. As a result of that increase in demand, we'll see an increase in the price of those previously issued bonds. We could look at it graphically as well. We could say if the Federal Reserve chooses to buy bonds, the result of buying bonds is that they are going to infuse money into the banking system. That's going to cause the money supply to increase. Interest rates will fall. In the market for previously issued bonds, the Federal Reserve is stepping in and buying more than before. That's an increase in the demand for previously issued bonds. And that increase in demand driven by the Federal Reserve causes the price of those previously issued bonds to go up. So we see that negative relationship. A decrease in the interest rate leads to or results in an increase in the price of previously issued bonds. We could look at it the other direction. If the Federal Reserve chooses to sell bonds in a limited reserve system, if they're selling bonds, then that means that they are offering bonds to the banks and taking money from the banks in exchange. That'll cause the money supply to shrink. That's going to cause interest rates to rise. If the Federal Reserve is selling bonds, there are now more bonds on the market than there were before. So the supply of previously issued bonds has increased because the Fed is now selling more than before. That increase in the supply of bonds in the market will drive the price down. And again, you see that relationship. Increased price level leads to a lower price of previously issued bonds. Again, the big takeaway of monetary policy is that it has everything to do with interest rates. Higher interest rates means less aggregate demand. Lower interest rates means more aggregate demand. How we change those interest rates depends on whether it's ample or limited reserves. And so continue to work your problem sets. Come to class with questions if you have them, and I will talk to you then.